Okay, team, let's take a quick look at how transactions affect the accounting equation. Now, I specifically chose an example here that did not come from our textbook. That way I don't have to worry about giving away any answers or anything like that. So I chose something that we could work through together. Now, keep in mind that what we're looking at here is the type of analysis that you would do before you get into debits and credits, okay? So what we're doing here is not about debits and credits. It's simply about understanding how different transactions affect our accounting equation, okay? So what they give us here is this company started with the following balances, okay? Cash, $37,000. We have a balance for office equipment, building, land, notes payable, accounts payable, and owner's equity, which in their case is just capital stock. Okay, so we start out by entering those balances here. Okay, so that is the first line that we have here are those beginning balances. Now, what we're going to do is look at the transactions that occur during the period and determine how those affect the accounting equation, okay? So let's look at this first one. Sold capital stock to owners. What that means is the owner invested in the business. The owner put in $35,000 in cash in exchange for $35,000 worth of capital stock. So what happens? Cash increases by $35,000. Capital stock increases by $35,000. Okay, at this point, we can compute our new balances. You'll see the only balances that changed are going to be cash and capital stock. The remaining balances did not change because we did not make adjustments to those accounts. All right, so let's look at item 2. We purchased land in an office building for a total price of $90,000. $35,000 was the value of the land and $55,000 was the value of the building. We paid $22,500 in cash and signed a note payable. That is a liability for the remaining $67,500. Now, in this case, we have several accounts that are affected. And that is quite common in real-world accounting practice. It's very common for a transaction to affect several accounts. As long as our equation remains in balance, that is perfectly fine, okay? So let's look at our accounts that were affected, okay? Well, we paid $22,500 in cash. Anytime you see paid, you know that your cash balance is going down, okay? We paid out $22,500. In exchange for that, we got $55,000 worth of building, and we got $35,000, which was land. Okay, so both of those accounts go up respectively. Additionally, on the other side of the equation, we now have a liability. We now owe $67,500 on that note payable. So that account increases. At this point, we can recompute our balances, okay? And again, we just take the prior balance and adjust for any change that occurred on that transaction. Okay, we do that all the way across. Item 3, we're going to buy some computer systems on credit for $9,500. Okay, I'm going to give you another hint here. Anytime that you see bought on credit or purchased on credit, that is a red flag that it is an accounts payable. If you buy something on credit, you are going to be recording an accounts payable, okay? In this case, let's see, it's $20,000. We put $20,000. Oh, I'm so sorry. I was on the wrong one. I'm sorry, $9,500. I'm sorry, $9,500 is what we're looking for here. So we go down here, $9,500. We put the computers and office equipment. So office equipment goes up by $9,500. And then we scoot over here, and accounts payable, a liability, also goes up by $9,500. And again, we recompute our balances. If the transaction did not affect an account, then we just simply pull the balance down. If the balance changed, then we put our new balance here. Now we move to item 4. Here's the $20,000. We obtained a loan from Capital Bank in the amount of $20,000. When we take out a loan, we receive cash, meaning our cash balance increases, but so does our liability because we are going to have to pay that $20,000 back. Cash goes up, notes payable goes up. Okay, again, we recompute our balances. If nothing's changed, that's fine. We just pull the balance down. If it's changed, we adjust for the change. Last transaction. We paid the $22,250 accounts payable due at December 31st. Okay, so when we pay an accounts payable, what that means is we have a liability and we're paying it off. Two things are going to happen. One, our cash balance is going to decrease. And think about it this way. When you pay your bills every month, your cash balance decreases, right? It's the same thing for a business, okay? When a business pays their bills, the cash balance is going to decrease. But guess what? Their liabilities also decrease because they no longer owe that $22,250. So cash decreases, accounts payable decreases. And again, we can compute our new balances based on that transaction. And if we take our total assets and we compare it to total liabilities and equity, we will see that our accounting equation is still in balance.